Welcome. We're glad you're here. As I shared yesterday with Russ on stage, it's about the tip of the arrow that we think about from a tactical viewpoint is pay less in taxes and figure out ways to give more. So I always start with, if you know the answer to that question, then the rest is just details. But let me give you a quick 90-second illustration. I gave a talk on stewardship and philanthropy to a group of some business owners in Fresno, California, just a few years ago. And there was a farmer in the room that I had known for years, and he asked, hey, could you spend some time with me this afternoon and to think through my portfolio and some of the things that I'm trying to figure out. And he was in his late 60s. And he had quite a few parcels of property, and he had a great production. He was doing about $4 million a year in production. That was his revenue. And he had all these different pieces of property, and he had 4 pieces of parcel that weren't contingents to the rest of his land. And I said, what's the profitability on this? My extended family are farmers, and so I'm familiar with how that works with your packing shed and production. And he says, it's profitable, but it's not as good as my core property. And I said, have you ever thought about taking that land and putting it into a donor advised account, taking the tax deduction, and then making a couple of phone calls and selling it? And he said, well, what do you mean? What's a donor advised account? And so we picked up the phone and we spoke and talked to Bryan out in Southern California, opened up an account within about 3 days. He donated the property into his donor advised account, which was valued at about $4 million. Took the tax deduction and rolled it forward for 3 years and sold the property within about 90 days and had about $4.2 million in his donor advised account and said, that was fun, now what do you want to do? Because it wasn't about the transaction, but it was about what did he feel called to do with now $4 million. It was what impact and how is the world different because of this incredible blessing. So you're going to hear this morning from Ron Blue Trust and just the whole concept around being strategic with the resources and the platform that God's blessed you all with. So Russ and team, thanks. You guys, we're looking forward to hearing from you this morning.
Thanks, Steve. Steve.
Oh, yeah, there you go. Go get it, Michael.
Okay, well, we're going to share a few things and then let you guys ask us questions. But I'm going to start with this handout I just gave you to kind of unpack a little bit more the comment I made last night about the fact that my concern for business owners is that they're going to stand before God and he's going to say, how'd you do with what I gave you? And they're not going to have a good answer. And the reason has to do with this issue of net worth or cash flow or asset giving versus cash flow giving. So I'm going to do a little test here. In this scenario, you can add zeros, subtract zeros, whatever, but you get the idea that we have cash flow giving. So in this person's case, he's tithing, right? You see the $50,000 on his income, and he's saving $100,000 on his margin, living, giving, paying his taxes. And then on the other side, you see some growth in net worth. Now, I know you're thinking, hey, Russ, the market's down this year. My net worth's not growing like that. But you look back, let's keep perspective. In typical years, you ought to have a 5% growth, and so you have to look at that. But so here's the test question. How much is this guy's net worth growing over the course of this year? Give me a number. Give me a number. How much is this guy's net worth going to go up year over year given this scenario? I'm a former math teacher. I must not be doing a good job here. Okay, so his net worth, the investment account goes up 60, the retirement goes up 75, the business grows, 6%. So his net worth's grown 315. But he's also added, look at the left side, his margin, right, of 100,000. So in this scenario, the person's net worth's gone up 415. And so the question is, why is someone's net worth growing? So I think the first question you have to ask yourself is, why is it growing? It may be because I want to grow the business. I'll leave it to my kids bigger than it is. There may be reasons to grow. But I've observed over 40 years, people don't ask why they're growing it. And once you get to a finish line or an amount that's enough, and we believe at Ronald Blue Trust, you can draw a finish line and you know the answer to the question, how much is enough, then you have to say, okay, I don't have a good reason for my net worth to grow 415. Now, here's the cool thing about what we're going to talk about, tax planning and other things. I can give up to $250,000 of that $500 and write it off. We have a matching program in this country, okay? So maybe I take this 100 and move it up to the giving. Then maybe take some of this appreciated assets over here. So I can increase my giving up to $250,000, take it up 5 times, and guess what? My net worth's still going to grow, right? Because I'm going to get some tax savings out of that. The $150 in taxes are going to go down. So here's the punchline. I don't believe that you can give according to how you've been prospered unless you look at both sides of the equation. And because we live in such a great country where you can deduct it up to certain levels, and Mike and Bryan are going to talk about this, it doesn't cost you that much. Think about it. I can increase my giving $200, but I'm probably going to get $60,000 out of the tax box. So if I give $200,000 more, that's really only $140,000. My net worth has still grown almost $300,000. You follow me on that? No. So what we want to talk about, and I want us to start with, I'm going to ask these guys. So Michael King is an attorney at NCF. He can tell you what he does. He can tell you about the people he works with. And one of the real benefits of NCF is they help people with how to do some of this asset giving and make it easy. But I think we need to start fundamentally. I've got asked this morning, I made the comment yesterday, everybody in the room should have an NCF account. They said, how do you open up an account? So will you answer the question just simply, maybe a little more about what a DAF is and how simple it is to open an account. And so when I made the comment you ought to have an account, I wasn't saying you should go put $100,000 in it. You could, but you can open up an account pretty simply, and talk to you a little about that.
Yeah, so just in case anybody isn't familiar with the donor advised fund, the best way that I think about it is it's like a charitable checking account. You can contribute cash, stock, other types of assets into the account. You get an immediate charitable deduction when you make that contribution, but then those assets can sit in there and you can grant those out over time, over months, years, decades, even over multiple generations for families that put very significant assets in there and actually use it a lot of times in lieu of or in addition to a private foundation. The account's very easy to set up. There's no tax return or much to do in the way of compliance. You can go online and get an account set up in probably less than 5 minutes, 5 to 10 minutes. You can name your account whatever you want to name it. A lot of people will name it after the family. Sometimes we're discouraging people from doing that today just for a greater level of privacy. So a lot of people will choose Bible verses and just other things that have special meaning to them. As the assets sit in that account, they can oftentimes grow tax-free depending on the nature of the asset. And so those assets will grow over time and become larger and larger because of the tax efficiency of that environment.
So very simple to set up an account. You don't have to put in X amount of money, and once the money's in there, depending on how you invest it or if you leave it in an asset, it could grow. So Michael's at NCF. So I mentioned Helping Hands. So let's talk a little bit about Helping Hands. So Helping Hands came into existence, as I said last night, because we didn't want to risk the tax status of NCF. And Terry was warned by an IRS agent in the early 80s when he said, got the private letter ruling, you need to be really careful that you don't get crosswise, especially when you give to needy people. So thus he set up the Helping Hands, and over time, what is there, like maybe a dozen entities now, or 9 or 10? So talk a little bit about how that fits and how it interfaces with NCF.
Basically, for many of you in the room, hello. It's nice to see so many familiar faces. I feel as though I'm speaking to the choir. I see some new folks here, so hello and welcome. I'm going to stand over here so I don't bore this group over there.
So all these people already know you and they came anyway?
You know what? They came to hear you and Michael. I know they did. Helping Hands was formed, again, to come alongside the National Christian Foundation and assist in complementing NCF and carrying out its purpose and mission. At the same token, with the extreme growth of NCF, their liability and again, if I may speak for NCF, and their tolerance level for any type of, they're risk adverse. So Helping Hands was asked to come alongside and serve their givers by creating and forming certain organizations to do very specific gifting needs and wants that are, again, outside of NCF's wheelhouse, outside their sweet spot, or possibly prohibited by code, being a donor-advised fund sponsor. Helping Hands Ministries has 2 donor-advised fund sponsors that we use, again, to assist the National Christian Foundation, but the multiple organizations are really focused on one thing and one thing alone. That's people, that's serving individuals in financial need. Why did Jesus Christ die on the cross? For people. So basically, Helping Hands, I look around the room again, I know that Mr. Williams has a corporate assistance program with us. We created this special program for companies, business owners, to come alongside their employees. No time is greater than currently in this situation. How awesome is it to have employees who are being offered positions at other corporations, organizations, and when they look at their possible new employer, they say, you know what, I work for a company where the owners care about me. I needed a transmission, I needed a medical procedure. There's tax-deductible dollars readily available. To swing back to why were we formed, I don't want to take too much time, and Russ, you just cut me off when you want. I look around the room, I was going to talk about Crimson Trace, but again, we came alongside a giver who was working with the National Christian Foundation. For one reason or another, things didn't quite jive. So rather than allow the giver to go to Fidelity, Vanguard, or one of those organizations, they say, hey, Helping Hands may have an organization that can assist you in this endeavor. The example I use, and I'll do it really briefly, is a giver had an 8% interest in Crimson Trace. For any of you shooters out there, gun owners, Crimson Trace is the #1 gun sight, laser. If you put your dot on something, that's where the bullet will go. Well, the gentleman out in California had an 8% interest, which was equivalent to about $12, $13 million. And when he came to the National Christian Foundation and wanted to donate his interest, he couldn't cut out the reps and warranties. So there could be possible clawback. So they pick up the phone, they call Helping Hands. We have multiple organizations. We ran it through our Delaware Trust, Charity Asset Trust, and Smith & Wesson wound up purchasing them. We held the shares for about 3 weeks. The $12, $13 million came in. We held it for about 4 days, and then we shipped it up to the Donor Advised Fund at the National Christian Foundation. Hence, if there's any clawbacks, any reps, warranties, they're clawing back to an empty organization, a silo, so to speak. So those are the type of unique gifting opportunities.
Yeah, so two things. Stay right here. I'm going to use as an illustration. So in giving to individuals, Helping Hands makes that easy. And then things that would maybe be risky for NCF, an asset like he just mentioned, the little gun sight red dot deal, they will handle it. And then once it's converted to cash, which is what you want when you give an asset, a piece of real estate, whatever, you want to convert to cash because ministries like FCCI doesn't need a gun sight thing. They need cash, right? I mean, so eventually,
reps and warranties.
Yeah, eventually you want.
That's what they didn't want was the reps and warranties.
And so the beauty of these tools is that your church, the other ministries you support, it's a whole lot easier to have an account at NCF, and whatever asset you've got, we can figure out a way to give it, get it converted to cash. It sits up in your, as you said, charitable checking account, and it can go to your church. It can go to other ministries. And like I said last night, it needs to be here rather than Fidelity or Vanguard or Schwab or whatever, because I think there's an increasing risk that your money could get caught. In other words, if your church doesn't believe in same-sex marriage or whatever, they may not give the money there. So you mentioned the gun sight thing as an illustration for something. So talk. What are some of the assets that you guys have taken in? I know I love NCF because they have all. Tell us about your team. You have a bunch of attorneys, a bunch of really smart people to affect these things. So talk about that a little bit and some of the assets you all have taken in, and then see what questions we might have.
Yeah, we are a very unique organization, and we have a very unique team. We probably have 15 to 20 attorneys on staff, which is probably not common for any ministry, yet alone a Christian ministry. But a lot of the work that we do is centered around some fairly complex gifting strategies, but strategies that really leverage the tax results of the giving. So we pay a lot less in taxes, and we can give more. A lot of people don't realize this, but the vast majority of countries throughout the world provide no tax incentives for their people to give. So the U.S. with other countries, but it's a little bit unique. I oftentimes tell people the tax code is generous to families that are generous. So just with the example that Bryan just shared, the reason they gave that business interest instead of just selling it and giving the cash proceeds is we're able to effectively capture a double tax benefit. When you give an interest in a business like this family did, not only do they capture a charitable income tax deduction for what they gave, but then the capital gain tax that otherwise would have been imposed upon that sale is either dramatically reduced or in some cases eliminated altogether. And the one thing I will say is, particularly for the families that we serve, The taxes is not the motivation for doing their giving. But it is a stewardship issue, and that's the way most of our families look at that is, hey, this isn't the driver, this isn't the reason I'm giving, but I do want to be a good steward of all the resources God has given me, and if I can pay less taxes and give more to the ministries that I care about, I want to do that. So, Russ, you were saying about the type of assets that we take in, probably the three predominant categories. Obviously, marketable securities can be a very attractive and a fairly easy asset to give that's appreciated non-cash asset. But the three other categories that we predominantly see are gifts of private business interests, real estate, and intellectual property. They're really the three primary categories. Now, we've taken in other things, precious metals. We took in a yacht. So on a Cape, we took art. We take art once in a while. So we do see some unusual assets, but they're really the three predominant assets. And when you think about the wealth composition of families in the country, businesses and real estate are two of the most valuable asset categories that people have.
So when I started in the business back in the early 80s, I had a real estate, successful real estate gentleman that moved from Michigan to Paradise Valley, Arizona. So I was sitting with him, and he wanted to be a part of the History's Handful campaign, and that was Bill Bryce's campaign to get 1,000 men to give $1 million each and raise $1 billion to fulfill the Great Commission. So it's called History's Handful of people to affect history. And so we're sitting there talking about how is he going to fulfill his $1 million commitment to become part of History's Handful. And we're looking down on his net worth side. I'm going with what you're saying. He had a $172,000 note receivable from a piece of real estate he had sold on his asset side. Of course, he was getting interest. He was paying capital gain taxes that came in on an installment note. I said, well, you can give that. He had no idea. And I think, Michael, you've probably seen this, and so have you. People don't realize that you can give stuff, not just cash. As a matter of fact, to be a good steward, I want to, if I'm going to give $100,000 in cash and I've got an asset over here that's got $50,000 of gain in it and it's worth $100,000, like a publicly traded stock, maybe I bought it 15, 20 years ago. That is, we help our clients look through their assets and try to do a lot of their giving with, because you can just buy it back and get a step up in basis. You've automatically saved that potential capital gain tax. This is why it's almost impossible in this country to outgive God, because you know, you get a lot of it back. You said the double tax. You avoid the capital gain tax. You get a write-off for it. So it doesn't really impact your net worth that much. And net worth is a summary of every financial decision you've ever made. Your balance sheet is a summary of every financial decision you've ever made. So think about it. If I give $100,000, but I avoided, you know, a 30% effective tax rate, I saved $30,000 because I get a write-off, and I avoided 20% capital gain tax. The $100,000 gift may have only cost me or reduced my net worth $50. And so I want to just take off on what he said about you really should look at this side first, even to fulfill a lot of this. I mean, cash is great to give, but if you've got appreciated assets, you need to look at it and say, maybe I should to do something with some of that earlier. So what questions does that spawn? Go ahead.
Yeah, so if you have an asset that has multiple partners, like a hotel, multiple warehouse, or whatever, and you go to sell that asset, and my understanding is when you sell it, well, first of all of the partners have to get in on the idea of donating before it's sold. Otherwise, let's say I get $1 million, and there's $20 million, 20 partners, and that hotel is sold. I get $1 million of that. I'm one of the 20. As far as I understand it, I have no choice. I have to pay capital gains on that. I can't avoid capital gains because we all 20 partners didn't get together and say, yeah, we're going to do a donation. Am I correct?
So sometimes that is the case. It really just depends on the facts and circumstances and the structure. So if you have a partnership, and let's say that partnership owns just one property, one hotel property, well then any individual partner could just give an interest in the entity that real estate owns. So let's say that the real estate is owned by an LLC. Each individual partner could decide, hey, do I want to give or not? And instead of giving an interest directly in the real estate, they would simply give an interest in the LLC that owns the real estate. So that's very feasible to do. Where you can run into the situation that you're describing is if, let's say that LLC owns multiple properties and they're just selling one property and you want to... Oh, okay. Yep.
Basically, all of the partners are interested in taking and it's going to be a 40% capital gains tax.
Okay.
That's what the tax is going to be.
Yep.
So you get $1 million, 400,000 cash is going to go to the United States government.
Could he not give?
Well, so is it just own the one property, or do they own? Okay, so if they own multiple, or just that one property, each individual partner could give a limited partnership interest in that, whatever percentage they wanted, 5%, 10%, 40%, and it doesn't affect the other partners. So in that type of a situation, there's giving opportunities there. If 4 of the partners want to give, or 6 of the partners and the others don't, the partners not giving won't be affected by that transaction. So there should be a great giving opportunity there.
I think the punchline here is at least ought to look and ask. So my experience has been usually you can give it. Sometimes there's rare cases where, however, the operating agreement's written or other things you might not be able to. But in that case, if you have 20 of it and you only own 5%, you can either give your whole 5% or you can give half of that or whatever. It seems like, and that's what you ought to at least ask yourself. The thing is, you always ought to look over here and say, God, what am I supposed to do with this? Do I have something that's got, if you got something that's got 400,000 to gain, I mean, think about it. Yeah. Okay, so let's just think about that. If he gave the whole $1 million, he's going to write that off. He's going to say 300,000, assume you have other income and all that, and you can carry it forward and avoid 400. So you're going to be able to give $1 million, and it's only going to cost you 300,000 because you avoided the 400. Plus, you got a write-off of the whole $1 million against other income. Did I say that right?
Yeah, that's right.
I'm a little bit, I used to do this all the time. I hope I got that right. You're the attorney. Make sure I got the numbers right.
Yeah, no, that's exactly right. And a lot of times when you're giving these appreciated assets, there are opportunities, what I tell people, there are opportunities to capture double and in some cases even triple tax benefits from a single gift. So
explain that triple thing.
Well, the triple tax situation, when we have business owners that give interest in their business, and the same concept applies to real estate. There's 2 primary strategies that families will implement. If they're about to have a liquidity or sale event, they'll simply carve off a portion of that business, give it charitably. Then when the sale occurs, the charity gets its pro rata share, and they capture a double tax benefit there. They get the deduction and avoidance or reduction of the capital gain tax. The second strategy that business owners will employ is situations where there is no expected sale in the short term, mid-term, maybe even long term. They may be planning to hold this business for decades, maybe pass it on to the family over multiple generations. And what a lot of families will do in that strategy is they'll give relatively small interest in their business on an annual basis with the goal of trying to maximize their charitable deductions on an annual basis. So again, the tax code is very generous to families that are generous. If you're giving a non-cash asset, you can deduct up to 30% of your income. If you do a combination of cash and non-cash, because almost everybody, some portion of their giving is in the form of cash, you can go up to a maximum of 50% if you're doing both cash and non-cash giving. So you could do a gift up to 30% of your income in the form of a business or real estate gift, and then you'd have an additional 20% capacity that would have to be in the form of cash. And so a lot of families that we work with, they say, okay, well, let me do that each and every year. What does that look like? Well, because of the high correlation between the income that a business produces and its value, there's a high correlation between those two. For most business owners, it'll take a gift of between 2 and 4% of the business to hit that 30% of income threshold. And so most of these businesses are successful businesses. So you may have a family that's making a 3% gift each year, but their business is growing at 5, 8, 10, 12%. So even as they're doing this every year over a period of time, the actual wealth, the dollar wealth that they have in their business continues to increase. In the meantime, they're building up significant charitable assets and reducing their overall tax liability in significant ways. So with this strategy, they get a triple tax benefit. They get an immediate charitable deduction at the time they make the gift. And then as the charity simply holds that interest, the charity receives a pro rata share of any income and distributions that the business produces. And although we typically think of charitable organizations as tax-exempt entities, it's a little bit of a misnomer because there are certain types of income that even a charity has to pay tax on. And one of those is income from an operating trade or business. It's referred to as unrelated business taxable income. And so even though a charity has to pay tax on that, we have very specific structures that allow us to reduce the effective tax rate that the charitable piece pays. So for example, instead of paying a maximum 37% federal tax on ordinary income from an operating business, the charitable piece will pay a maximum of 14.8%. So that's the second tax benefit that can be captured. We got a charitable deduction, now we're paying a dramatically lower tax rate each year on the operating income. And then if or when the business is sold, again, we'll dramatically reduce that capital gain tax, or in some cases eliminate it altogether. So just like you did.
So you have a 23%, rather than that income being taxed to you, it's now accruing in your donor advised fund.
Right.
And even though there's a little bit of tax paid, because it's unrelated business taxable income, remember that, I said that right?
Yes. Yep.
That's a 23% benefit. And then if your business keeps growing, that asset is sitting there, that appreciation is accruing to your donor advised fund. It's not on your personal net worth. And I think that's what I hope you're taking away is, because what you just said is what I've seen happen. The businesses just keep growing, and their net worth's going up $1 million, $2 million, millions a year, and their giving doesn't keep up with that. And it can't keep up with it unless they figure out how to look over on this right side and start doing some stuff. So other question, you had your hand up.
Yeah, let me just make one more comment before we get to your question. So if you take a snapshot of the typical family before they implement a strategy like this, oftentimes when we first get introduced to a family, they're tithers because of their faith perspective. They're giving 10% of their income in the form of cash. And if you look at the numbers then, kind of like Russ laid out here, their giving is typically a fraction of what they're paying in taxes. So here, they're giving 50 and they're paying taxes of 150. So 3 times the amount they're paying in taxes as they are giving. But once they implement this strategy, what most of these families do is they were already giving 10%. Now they're giving a 30% of their income gift in the form of the business interest. They get a charitable deduction on that, which can save anywhere from 30 to as much as 50%, depending on what state you're in. And then what most of the families will do is they'll take a portion of that tax savings from the business gift, and they'll make an additional cash gift to take them to the full maximum deduction threshold of 50% of AGI. And so the families that are doing that, they basically flip these scales. They're typically giving a much smaller amount than they're paying in taxes. Once they implement this strategy, they're now typically giving twice as much as they're paying in taxes.
Yeah, so let's just have you write this down. If you go from 50 to 250, that tax box is going to go from 150 to probably 80. Okay, so now you're at 250 and 80 versus the other way around.
That's right.
And so I think that's what's so beautiful. It's a great country because, like you said, we get to have these tax benefits. You don't do it for the tax benefits, but that's stewardship. Why would you give $100,000 in cash if you've got an asset that's got $100,000 of gain in it? When I can give that and avoid the capital gain tax and be at the same place charitably.
And one of my colleagues, he often likes to share this, to encourage people to pay taxes commensurate with your lifestyle. So there's a lot of folks that we run into where their lifestyle could be multiples, exponentially greater than what they're actually consuming. And because of the way this tax system works, they're paying tons in taxes, even though they're living not an overly extravagant lifestyle. So this is the type of strategy that can help families pay income tax more in conjunction with the lifestyle that they're actually living.
And you guys know that lifestyle drives your taxes, right? Because the higher your lifestyle, the more you have to make to fund that, and typically your taxes go up. But that's why the giving is a good part of that. So let's come back. You got your hand up.
I'm honestly, I'm not even sure which question to ask. There's so many flying around.
Well, you have 3 people.
We've got time.
Ask 3 questions. Let's start over here.
So this is like the first time I've heard all this, so I apologize if y'all are thinking, what is she saying? So let's say you have real estate that you want to donate. So you would donate it to your donor advice fund. Is that correct? Mm-hmm. So what happens to that piece of real estate then?
So, well, a couple things can happen. It can be sold immediately if desired. either to a third party or Russ even touched on, we have some cases where folks will give a piece of real estate and they'll buy it right back. Now, why would somebody do that? Well, if you have an investment property that has been heavily depreciated and you're giving cash anyway, instead of writing the check, give the real estate, you can purchase the real estate back, reset your basis, and redepreciate the asset all over again. So, so you can have situations where the asset is sold immediately or in whatever time frame is appropriate. And then other families will give that asset and they'll just have it held in their donor advised fund. So if it's an investment property, now all of a sudden the rental income on that property, some portion of it will accrue to the charitable fund based on the ownership percentage. So if they owned the whole property, all of the rental income would come into the donor advised fund. Now, real estate's a little bit of a unique asset. If the real estate is unencumbered with debt, doesn't have any debt, then all of the rental income will come in completely tax-free, which is a great benefit because real estate is heavily taxed when you're just reporting it on your individual return. You've got federal tax, state tax, and then you have the 3.8% Medicare tax, so the tax gets pretty high. If there's debt on the property, which is very common with real estate, then it reduces some of the tax benefits of that, just because of the way that the tax code works. But in most cases, it's still a very attractive leveraged asset to give. So then let's say once either the rental income comes in, then those cash assets can be used to start granting out to charities, or if the asset's sold, once the sale proceeds come in, those assets are available, and all of those assets are directed by the family. The family basically says, hey, we want you to send $1,000 here or $100 here. Legally, the assets are now the ownership of the donor advised fund sponsor, but practically that's the way it works. The family tells us, hey, this is what we would like to do, and unless it's something, a gift to a charity that's violating biblical principles, we'll grant those assets out.
Ryan, you look like you were going to say something.
What's that?
Brian looked like he was going to say
I was going to say, Stuart's raising his hand because he knew I was going to say, if you want a real life experience, Stuart can give you one he just did recently, and it's
so
snap, right?
Here's how all this. So here's how all this ties together. Let you ask your question. So most times, as the donor, you don't want to handicap the charity with trying to sell it. They expect you to be able to sell it or whatever. Many times it's part of an estate plan. I had a client give 10% of his business. The son was coming into the business, so he bought the company stock. Rather than buying it from his dad, he bought it from the foundation. And so remember, we want to get the money to further the kingdom of God. So I mean, you guys can hold stuff, but in most cases, I think the idea is you want to get it in there, get it to cash, so then you can distribute it out to ministries.
Okay, and so that was my follow-up question is, what ministries do you have the option of donating to? Is it just...
Yeah, it's largely any 501c3 publicly traded charity. So that's the requirement that the government, the tax code imposes. We can only grant out to public charities. So we couldn't grant to a private foundation or most types of private foundations. And then the additional screen that NCF has is we will review the charity to ensure that it doesn't do things antithetical to the Christian faith, which is a very small group of organizations.
Really, you get probably wherever you're giving now,
yeah.
They're going to keep giving there. And then if you want to go to people.
That's what I was just going to say. And if it's not a publicly traded, then...
Right. Correct. That's where the greater way to give comes in.
Yeah.
When it was outside NCF's wheelhouse, we were making social impact investments out of one of our foundations back in 2000, 2001. It's become a really big thing, and some organizations are really huge from those social impact. But again, getting back to being here at FCCI and having Terry Parker, all of us kind of tutored and mentored under Terry, being the creator that he is, and I always say God's the great creator. Terry was just able to come over to Helping Hands and create these orgs to, again, complement and assist the National Christian Foundation. And yes, our specialty is gifting individuals. Last year we gifted $1 million a week on average to individuals. Average check was $1,500. And again, the Lord's just been really good. It's encouraging to be here with you. There's a lot of green dots in here, I see. And so that's why I was speaking specifically to you. It's very encouraging to be here.
Did you have a question?
Stuart.
You weren't just waving at Bryan, or?
Yeah, I did have just, my question was, you talked about if you had a property that was depreciated, that you could put it in a donor advised fund and buy it back and start depreciating it again? Can you help me understand that?
Yeah, I mean, when you give an asset like that, whether it's a business or real estate, the giver themselves or their family or their kids, sometimes we see this done in a business succession plan where somebody says, hey, I want to leave this business to my kids, but I am generous. We'll do some of that annual giving, and then the kids or a trust for their benefit will eventually buy it out. So that's permitted under the code. You have to be very cautious to follow the proper rules. So you need to ensure that any sale transaction represents true arm's length fair market value. That's really the critical key. And so a lot of times we'll have an appraisal that's done to confirm that, hey, what the family's buying this back for is what it's really worth. If they're doing it in close proximity, they have to get an appraisal to substantiate their deduction on the return anyway. So sometimes if that's the family's intention, they'll do that pretty quick. They'll give it and purchase it right back. But there's no prohibition on doing that. There's IRS cases and rulings that have where families have done that type of planning.
So let me just so remember how Frank said public and private. So if you had a $100,000 Coke stock and it was all gain, you could give that and then take the $100,000 you would have given and buy Coke stock. What would your basis now be? It'd be $100,000, right? So it's really that's exactly what happens with privately held assets. Once you've given it, now if I buy it at fair market value. So just think about that. If you did it with a publicly traded stock, it's the same thing here. So if you have $100,000 of Coke stock, you have no basis in it, you give that, you get a $100,000 deduction. Instead of writing a $100,000 cash check, take the $100,000 of cash that you would have given and buy the Coke stock back because you want to hold it.
Yeah, I get it with the stock. With the real estate, I just wondered if there's...
That's just pretty much the same thing as long as you have appraisals and follow all the rules. And that's the biggest thing I hope you get out of this is, you have so much more potential than you realize. And that's why these vehicles, NCF, Helping Hands, need to be part of your... And attorneys aren't going to lead with this, and your investment people aren't going to lead with this. Because they don't want you giving away stuff, right? Because they get paid off of the investment pile. So you just need to know that these should... That's why I was bold last night to say everybody should have an account, because if you're going to give the way you've been prospered, at some point, it's not just going to be on the left side of this sheet. It's going to you have to look to the right side. And these guys and their entities and the people they work with and NCF and Helping Hands can help you do that. Really, pretty much whatever you can think about will help you figure out how to do it.
So somebody sits down with you and you say, here's my financial statement, here's my income, my cash flow. Take a look at this, help me figure out what I can do so I can get better.
Well, so you just set up, I'm just going to do a plug for Ronald Blue Trust. I mean, our purpose is to help Christians free up resources to fulfill the Great Commission. So what we've done for 42 years is look at your stuff. If you give me your tax return and your balance sheet, we'll eventually need to get your wills at some point. But if you give me those two things, then we'll, I'll just tell you real quick. I'll tell you, case in point, guy came over from Alabama. We're $34 million. Most of it's in real estate and businesses. He starts off the meeting by saying, I want to sell the real estate in the next 18 months. Well, what do I immediately start thinking? And then he says he's an attorney and said, I just got a $3 million settlement this year. So his income's way up in 2022. So I'm just like, I usually don't get real prescriptive in the first meeting, but I went up to the whiteboard because I was drooling, because rather than rather than selling that real estate, I'm thinking, okay, we're going to give enough real estate up to 50%. We're going to do the thing to get it up to 50% of this year. Oh, and your estate plan, guess what? You're over $24 million, or the amount you can leave tax-free. Let's put that in a charitable remainder trust. So yeah, you look at everything. Look at their long-term plan. Here's the other thing: if you're going to give it away in your will, and one last comment: if you're going to give it away when you die, why don't you pull it forward? Several things. The ministry needs it now. You get a deduction now. You get the joy of giving it while you're alive. So if you should have charity in your documents, but how much more fun if, like I automatically thought, if this guy's going to leave everything over the tax-free amount to charity, let's just do a charitable remainder trust now. He can get, anyway, all kinds of beautiful planning. Tremendous planning opportunities when you include charitable ingredients. That's the punchline. So yeah, and so
Yeah.
what we do at Ron Blue is we look at all your stuff, and then we bring in and quarterback with the donor advised fund folks.
Ron Blue is my tax accountant for all of our companies, and, you know,
Well, they're doing the tax stuff, but you need a planner too. You need somebody that.
so we hired you guys 2 or 3 years ago, but nobody's talking to us about any of this stuff.
Well, you need a Ron Blue advisor, which is different than a tax thing. Tax thing's compliance. We started that group years ago. We can talk about that a little bit. Go ahead. You had. I just ignored that buzz thing.
Just talk right through it.
Just letting us know a hurricane's on the way. Like,
Oh, I thought it was everybody run back over.
No.
Oh. I thought they were telling us we were done. Everybody
Russ
had to move back
doesn't
to.
do real well with shut up and sit down. He heard that buzz. He's like, I don't even hear that.
No, I really thought they were telling us we were done. Okay, it's just a hurricane. We'll just keep going. Okay.
Hey, Russ, just to piggyback on what you just said. So one of the things that we'll do, oftentimes in conjunction with RBT, if somebody's looking at a specific transaction or strategy like we're talking about here, we'll model that out. We'll create like a proposal or an illustration to actually quantify, well, what does this look? What are the charitable benefits, the tax benefits? What does the family still walk away with? And that really is very helpful to serve as kind of a decision tool to say, gee, is this really helpful? Does this help me better achieve my goals and objectives?
So they'll look at the tax implications of the gift. What we will do is look at all of your stuff, your living expenses. We look at everything because the gift is a part of that. But like this one lady, they gave 20% of their company, and her question was, now who's going to pay my medical insurance because I don't have the company anymore, I don't have a $600,000 salary. So that's the part. It really is, we look at everything, and the CF will really help with the tax and the giving part.
okay, I just thought of another question. So, let's say our company's giving $100,000 to a specific charity every year. Would there be a benefit? Is there a benefit to put that into a? Do you guys abbreviate it? Can we abbreviate
Yeah,
it?
sure, yeah, we call it a DAF. Yep.
I'm not going to say the whole thing. Okay. Would it be beneficial to put it into a fund and then give it back to that same charity that we've been giving to? Is there any benefit in that rerouting of that direction?
Sometimes there can be, sometimes there isn't, if you're just writing checks.
Yeah.
But for example, like if you're giving through any type of an appreciated asset, whether marketable securities or something else, by doing it to the donor advised fund then eventually liquidates that asset, and now those funds can be distributed out to multiple charities.
I would say simply put, if it's cash, no benefit. If it's appreciated property, you should have it, or if you want to do it anonymously. Or if 100,000 is going to multiple, if one just one place, it's going to multiple. So, I mean, if it's appreciated property, you got to have this account. Because the charity doesn't want, they don't want your stock. They don't want to have to deal with it. Even though some charities are set up, they got brokerage accounts, they can do it. It's just easier this way.
And there's a lot of families that will use their donor advised fund to consolidate their giving from a tax perspective. So they do all their giving from their donor advised fund, and then they just need one receipt for their tax return. Now, if you're doing that through the business is set up from an accounting perspective, so it should be pretty easy to get the necessary receipts. But certainly at an individual level, that's very helpful. Even for somebody like me, it saved me hours tracking down, receipts and going through my checkbook, and then I lose one, and I got to call them up and say, can you send me another one? I did have it, but I can't find it now. So that can be helpful.
So I want to be sensitive to, I think we're supposed to be done. So we're around, today, tomorrow, unless we have more buzzes like we just got, and we all have to leave. But feel free to seek out Bryan, Michael, and myself and ask questions. But thanks for coming. More questions. We're happy. Well,
Happy to answer them.
did we ever answer?
I didn't know.
Oh, go ahead. Wait, one more.
So one quick comment and then one answer. So the only potential that I can see from a benefit with cash is if you were to alternate. So a lot of our clients give to donor advised funds in alternate years if they're just a little over the standard deduction, because that way in the other years you can still take the $25,000 standard deduction.
Yeah.
And so even with cash, there's a little benefit.
Can be.
Potentially, but the real quick question, so I'm still a little bit vague on helping hands, so let me ask real quick if I can clarify the purpose for it. So donor advised fund, obviously we need to be really sensitive about, and effectively we're not giving to any individual because it has to be a public charity. Helping Hands happens to be a public charity that can can work with individuals and or kind of corporate care plans to specifically get out. If we have a donor advised fund, we can kind of direct to that public charity that can help achieve our goals specifically.
Correct. So real simple. I have a donor advised fund sponsor. It's not Christian based. It's called NEMA Foundation. That's amen spelled backwards. At the same token, the reason that we have a donor advised fund sponsor is if you have a $10 million DAF with the National Christian Foundation, you're the business owner and you say, hey, I'm starting a $100,000 match for my employee benefit benevolence or corporate assistance program. If you have 5,000, 10,000 employees and you want them to participate, the expectation isn't that they're going to dump into a donor advised fund at the National Christian Foundation. Provision Bridge, which is our DBA, it's a provision bridge to multiple organizations to do multiple charitable gifting. Everyone will dump into Provision Bridge. So you have basically your own private United Way donor advised fund with Provision Bridge. Employees and employers make contributions to that fund. We have bylaws and amendments that are set up specific to IRS guidelines. You decide, is it the day one, who qualifies? Is it day one, dollar one? I say yes. When you bring your baby home, it's day one, dollar one. Secondly, what qualifies? Car repairs, medical situations, house fires, maybe one of the spouses passes away or leaves. You do a scholarship program in conjunction with financial need funds. And last but not least, what is the dollar amount that any employee can receive from this program in any given year? Is it $2,500, $4,000? What is it? And then with the business owner, if they say, well, Bryan, they need $7,500 to meet their deductible. And I say, well, your cap is $5,000. Well, take $5,000 from the donor advised fund there. If you want to write a separate check for $2,500 to meet the need, because we need to maintain the integrity of your program. So if we have the bylaws and amendments, we have about 250, 300, a little shy of 300 companies right now. We've never marketed or solicited. We do not fundraise or ask anyone for anything other than how may we serve you.
We're around. Thank you all very, very much.